Friday, April 19th, 2019, Maneco 64, home of alternative economics and contrarian views. So being Good Friday today, I didn't do a video this morning because the markets are shut all over the Western world at least. They'll reopen on Monday. And so I'm not really looking at the screen today, looking at where the markets are. I'm just going to talk about derivatives. Many of you know that I used to work in the city of London in the financial sector. Before that, I started out in Geneva, Switzerland for a small private bank or portfolio management firm. So I have been exposed to derivatives since the late 80s, and I've learned, of course, about derivatives as I worked in the city, and I was a futures and options broker, which is a derivative. There's two kinds of derivatives, trading of derivatives these days. You've got the exchange traded derivatives, which is the traditional type of derivatives, and then you have the over-the-counter derivatives, which are traded amongst private parties, between banks, their clients, between two banks, government institutions, and I want to basically make the general public aware of how dangerous the OTC derivatives really are. I mean, in the US, the commercial banks were not allowed to trade in derivatives up until 1999, and then we got the repeal of Glass-Steagall under the Clinton administration, and we know what's happened in the last 20 years since that's been repealed. The other thing about derivatives that people need to keep in mind, and some of you might have seen the movie The Big Short. They talk a lot about derivatives, and I highly recommend that movie, The Big Short. The thing about them is that they're side bets, especially in the derivatives, financial derivatives market. They're side bets on underlying instruments. And I would argue that derivatives has made it possible to keep this fiat Ponzi going for a lot longer than most people could have imagined, in my opinion. You know, since August 1971, when Nixon temporarily suspended gold convertibility for the US dollar. So it's been almost 48 years. It's going to be this August that they've been able to keep this Ponzi going. Of course, the petrodollar has helped. The fact that every country in the world virtually until recently had to use dollars to buy not only oil but every other commodity, and I think that's changing. And I recommend Antal Fekete. That's Antal Fekete, Fekete. If you Google that, Antal Fekete derivatives, fiat money, I think you will find stuff that he's written about how, yeah, the derivatives monster or bubble is used to actually manipulate and control prices of underlying assets like US Treasuries, interest rates, precious metals. We know that they use the derivatives to manipulate the prices. But are derivatives in of itself a bad thing? Well, there are some, in some cases, like agricultural derivatives, which evolved, for example, in the 19th century. You know, the Chicago Board of Trade. That was usually for agricultural goods, farmers, cattle, and farmers needed some kind of secure income because of the variable weather that you get, damage to crops. That's how it evolved, the futures market. And it was based on something real, like wheat, corn, soybean, pork bellies, cattle, orange juice. That's what really derivatives were there for. Of course, there's been always speculators who trade in this market, and they actually provide a service, which is liquidity in these markets. But so up until the 1970s, derivatives, that if you talked about derivatives, and it was usually to do with these soft commodities, and not with financial assets. Prior to 1971, interest rates were relatively stable because of the gold standard. So there was no need to hedge like there is now. So if you look at the history of the T-bond future, the 10-year note future, the euro-dollar future, and the euro-dollar future is not on the euro-dollar foreign exchange rate. That's on the 3-month LIBOR rate, which is London Interbank Offered Rate. That's one of the oldest financial futures that exists, alongside the T-bond futures, the 10-year futures. That evolved like in the 80s, and it's kept mushrooming. Yeah, I would argue that that's what's used to manipulate the markets and interest rates. That's how they're able to keep interest rates as low as they are. And, sometimes I ask myself, how can interest rates still be so low if there's so much debt? But you need to look at it the other way. It is the low interest rates, or almost zero cost of money, really. If you calculate for the real rise in cost of living, money is actually free. And when money is free and assets are manipulated higher, people are able to keep borrowing and borrowing, and that's why the debt bubble keeps growing. And I think derivatives, even as Warren Buffett said, I think it's over 20 years now, he said that they're weapons of financial destruction, weapons of mass financial destruction. And there are a lot of victims of financial derivatives. Orange County, California, they went bust, I think it was 1994, because interest rates rose quite sharply. In 1994, there was a mini bond crash, and there was a lot of victims, like Orange County. You have the country of Greece, which they were sold, and these are all over the counter. These are the Wall Street banks selling these weapons of mass financial destruction to counties, to countries, and you can bet they're still doing it. What about Greece? Well, Greece wanted to join the EU, or join the euro, in early 2000s. I think it's 2002 or 4. Don't remember exactly the year. And Goldman Sachs made sure that their numbers, they basically fudged their balance sheets, able to qualify to become, to join the euro currency. They took a lot of their liabilities, their debt off their books through over-the-counter derivatives, and we all know what happened. A decade later, Greece went bust, and the bankers were made whole, and the Greek people are still suffering for it. All the debt that they've had to incur to keep this Ponzi going. What other victims are there? Well, I would say 2008 crisis. AIG, supposed to be an insurance company, but they had an arm, AIG Financial Products, based in London. They're based in London, probably all offshore based as well, operating from London. And why did they base themselves in London? Why not in the United States? After all, American Insurance Group, or International Group, AIG, it's an American company. Well, that's the other thing. That's the key to the derivatives as it relates to London, the City of London. And what is that? Well, because in the City of London, the regulations allow, banks, investment banks, the participants in this market to hypothecate to their heart's desire, rehypothecate to the 100th times. While in the US, there's a limit to hypothecation, how much they can leverage. So that's AIG, normally just a normal insurance company. They got involved in selling insurance for financial products through London. They leveraged themselves, and the US Treasury, I think they had to bail them out. $164 billion, or else the whole insurance market would have collapsed. That was pure speculation. Goldman Sachs was heavily involved in that. So they bought a lot of this insurance that AIG sold, credit default swaps, and it was not supposed to go wrong. So Goldman Sachs was going to lose out billions, but they got paid 100 cents to the dollar because the US taxpayer, and not only the US taxpayer, but the British taxpayer, European taxpayer, because you need to understand that these international companies, international banks, AIG, Goldman Sachs, Soc Gen in France, Deutsche Bank in Germany, ABN AMRO in Holland, Goldman Sachs in the US, JP Morgan in the US. They're all interrelated, and they do business everywhere. And that's why the Federal Reserve, when they bailed out Wall Street, they didn't only bail out American banks, they were bailing out foreign institutions. And I think there's a testimony to Congress where the lawyer for the Fed, or someone from the Fed, or even Bernanke said, "Oh, I can't tell you who it is." So that's what put I would argue, if you need to watch also Best Evidence, which I have, John Titus, which I have recommended through my videos before. Yeah, I highly recommend that YouTube channel, John Titus's Best Evidence. And he talks about how actually Main Street was not in trouble in '08. It was mainly Wall Street that was going to implode. And that would have been a good thing. And the thing is that nothing has been changed. Derivatives are still out there. Some people say that the notional amount of derivatives, and what does that mean? Well, each derivative has like a contract size. OTC derivatives are different because it's all tailored. So it's like a very opaque. I remember in '07, before when the crisis was brewing, there's a lot of talk that the New York Fed had to have emergency meetings to try to go through these contracts, and you could see there was something wrong, and that hasn't changed. The investment banks, the hedge funds, they're still using OTC derivatives. And why do they do that? Well, because in the exchange traded derivatives, the market that I was involved in, futures and options, all the information is publicly available. The prices are more liquid. So the bankers in an OTC derivatives market, they can really rape their clients, because as you will see in the Big Short, some of you might have seen it. A lot of the people who made a lot of money in that movie, they were doing OTC derivatives with the big Wall Street banks. And when the market started going their way, it was very frustrating for them because the Wall Street banks didn't think, what was happening could happen, and they didn't adjust the prices. They were like, instead of bidding 10 for something, they're still bidding 1. And you will see the frustration, of dealing with the bankers in a over-the-counter derivatives market. There were estimations that, so the notional amount, for example, if I buy a Treasury note future, I control $100,000 of Treasuries, nominal amount. if the price is 120, it's going to be 120,000, but you only put down $5,000 or so. It's very, very leveraged, these derivatives. So yeah, the estimations were that the derivatives market was 1,000 trillion around the '08 crisis, or 1 quadrillion. And after that, though, the BIS and the ISDA is the International Securities Dealer Association. They kind of changed the accounting for derivatives. So then they'll talk now about the notional amount being 600 billion. But I would say it's probably north of 1,000 trillion. And nothing has changed. And that's what the city of London and Wall Street has become. They've become casinos where people trade these derivatives, back and forth, not really adding any value, social value to society or the economy. And I'm not saying that there isn't business done in the financial sector that does add value, but it's become, derivatives have taken over. And right now, I think, from what I've been reading and listening to, it looks like people think that the US and Western Europe, the UK, they can keep going like Japan, just keep the deflationary, they call it deflationary environment going, low interest rates. It's just going to keep hurting the economy, because when you have the demographics, people getting older and older and not getting an income from lower rates, that's going to make it even worse. The other thing that very low interest rates do is that it allows businesses, industrial businesses, manufacturers to keep getting cheap finance, and they can, the supply of goods remains very elevated. So, prices can remain low for certain goods. Am I saying that there is no inflation? Of course there is inflation. We know the cost of living is going through the roof. We know there's shrinkflation. But yeah, I think derivatives is still a huge problem, and they haven't done anything to solve it. Yes, some banks, with the Volcker rule, have stopped a lot of the trading, but they've just outsourced it to the hedge funds. The hedge funds are just like a lot of the traders from banks that, start their own, trading operation. But who do you think they get the money from to start these hedge funds? From their, their previous employer. So hopefully this is not too boring. Derivatives, yeah, weapons of mass financial destruction. Even Jim Rickards, who worked on Wall Street for the big banks, he thinks they should be banned. But maybe it will be something that will be not exist in the future. And that would be a symptom that we go back to a monetary system that's based, like a gold standard that we had prior to 1971, a monetary system that has some kind of anchor, and where, how can I say, exchange rates are fixed, to a store of value. Yeah, I haven't even touched upon foreign exchange futures. There's foreign exchange futures, forwards. That's a kind of derivatives as well in foreign exchange. Prior to 1974, foreign exchange wasn't a big business because exchange rates were fixed. But then with the floating rate exchange that we've had since 1973, it's become one of the biggest markets out there. I'm not sure. I think they trade over $1 trillion a day foreign exchange. And that's where the gold is traded as well as XAU-USD, silver as well, XAG-USD. It's traded as a currency. and they just leverage it. There's nothing behind it physically, and that's why they've been able to keep controlling the price of gold and silver. Will they be able to keep this game going? Well, I think they can. You know, a lot of people, mainstream economists, Wall Street, City of London, they think we can keep going like Japan has kept going. I'm not too sure. And I think the derivatives, that's the important part of the whole, you know, house of cards, what keeps it going. So we need to keep an eye on derivatives. Of course, it's hard to keep an eye on derivatives, especially OTC derivatives, because it's over the counter. You can't call Goldman Sachs and say, you know, how's your derivatives book? And the other thing about all these derivatives is that they are off balance sheet. The OTC, the exchange traded, so you can't really tell the health of a financial institution that clearly, in my opinion. And they're all a lot of these hedge funds as well, and they're all offshore based. And you know, we know these offshore centers are not very well regulated. Derivatives, I think that will be the big you know, when this system comes down, the derivatives bubble will come down with it as well. And I think that's, you know, that will be a good thing. So if you enjoyed this video, make sure you hit the like button. If you enjoy my videos but haven't subscribed yet, think about subscribing. Make sure you hit the little notification bell above to be notified of my new videos. And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great Easter weekend. I'll talk to you later. Take care. Bye.